Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us is Kevin Mahn, President and Chief Investment Officer with Hennion and Walsh Asset Management. Kevin, it's great to see you. As always, welcome back to Trade Talks.
You as well. Happy holidays, Jill.
Yes, and same to you and your family. And as we get into the end of the year here, let's get an update on the Federal Reserve's TNT program.
Yes, of course, that TNT standing for taper, narrow, and tightening. And we like to joke here that if, in fact, the Fed gets their TNT program wrong, they risk blowing up the U.S. economy. But essentially what they've told us as of the end of their last committee meeting of 2021 is that they're going to increase the pace of their tapering, now buying $30 billion less of treasuries and mortgage-backed securities each month. And if you do the math, Jill, that takes us out to the end of the first quarter of 2022 when tapering should be completed. At that point in time, the Fed can then focus on the N and the T, narrowing or shrinking the size of their $8 trillion balance sheet. And of course, what everyone cares about, the tightening. When will they raise interest rates and how many times will they do it? Based upon their most recent updated dot plot chart, it seems as though consensus is calling for 3 rate hikes of 25 basis points each in 2022, but I think it's more likely to be 2 interest rate hikes next year.
And Kevin, status lay hit some bumps along the way here in December with this recent bout of market volatility. Did you take advantage of it here?
Yeah, I think it was caused by 3 factors. First and foremost, the Omicron variant and how governments might react to the spread of that particular variant of COVID. Secondly, what the Fed may or may not do in 2022. Will they be as hawkish as their recent pivot is suggestion? Again, I think that they will not. And then finally, it's been a great 3-year run for stock market investors. And I'm sure many of those investors took some of those gains and are looking to redeploy those assets into different areas of the market that may offer growth potential next year.
Do you believe that the overall macro outlook for 2022 will be consistent with the theme of still growing yet slowing as it relates to both economic and stock market growth?
Absolutely. We just published our top 10 investment themes for 2022. And our theme for the year is still growing, but yet slowing, both as it relates to economic growth and stock market growth, and perhaps even inflationary pressures. We think inflation remains elevated in 2022, what will come down considerably from the peaks that we saw in 2021 later in the year. So expect a little bit slower growth, a little less stock market growth, and hopefully a little less inflation.
And Kevin, given this outlook, will investors have to be a lot more selective to find pockets of growth and income opportunities for 2022?
Absolutely. Certainly, if you were in U.S. large cap stocks over the last 3 years, you've done very well. Looking ahead, given where valuations are right now, given the pace of the economic recovery, and given the likelihood of tightening coming from the Federal Reserve, investors may need to look elsewhere and consider other market capitalizations, other geographies, and quite frankly, other sectors.
Right. And to wrap up here, what are a couple of areas worthy of consideration to fit these objectives?
Sure. In terms of growth opportunities that we see, one area that we like for 2022 is financials, specifically smaller cap regional banks, community banks, and mortgage and thrift institutions. Historically, financials have fared pretty well when rates are rising and when economies are expanding. And the pace of M&A activity of these smaller cap regional banks did pick up at the end of 2021. So we hope that carries forward into 2022. In terms of income-oriented opportunities, we like municipal bonds and municipal bond closed-end funds in the new year. Consider these stats, Jill. By the end of 2024, 21% of all outstanding tax-free debt is scheduled to either be matured or called. And by the end of 2026, that rises to 31%. Nearly 1/3 of all municipal bonds are set to mature or be called by the end of 2026. In all likelihood, there won't be additional supply to meet all of that debt that's maturing or being called. The demand for tax-free income will increase as taxes increase, supply is going down. That should bode well for the prices of municipal bonds and municipal bond closed-end funds.
All right, Kevin, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.